This is Asia Trade. I'm Shery in Tokyo alongside Haidi Stroud-Watts in Sydney. The top stories this hour.
This is my last press conference as chair. I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor.
A divided Fed holds rates as Powell bows out, but stocks and bonds fall with policy division deepening amid uncertainty around the Iran war, the yen sliding to its weakest since 2024. Alphabet shares soar in late trade as AI investments begin to pay off, but investors are less impressed by Meta's big spending plans. Plus, Samsung's final first quarter earnings due this hour as Asia's tech giants challenge the Magnificent Seven.
Well, as Shery mentioned, it is very much a split sense of confidence when it comes to these markets. You still have that resilience when it comes to the Kospi, really defying this tech-driven jitters-led sort of sell-off that we've seen across global stocks, but particularly, of course, across the US. And that theme really continued given how much divergence we saw in some of these big tech numbers. Meta, of course, a disappointment. We did see that recovery in US futures reversing some of those declines on account of what we saw in the numbers out of Alphabet. But as Shery also mentioned, FX is very much in focus at the moment. The yen falling below that 160 per dollar level to the weakest since 2024. We're now sort of on intervention watch with officials that could very much be in the space to step in to support the currency. Take a look at what we're watching in terms of tech, though, because that will inform how we see Japanese, Korean, Taiwan markets when they come online later on in the Asian trading day as well. Meta still continuing to see that downside of 5.5% there. We are seeing a little bit more stability when it comes to some of the bigger Mag 7 names, Microsoft, Alphabet among them. Qualcomm also putting on 12.5%. Switching out the board to take a look at the story with oil, because so much of this still boils down to that uncertainty as to where we go next with the US-Iran war. There are indications that the US administration are kind of pretty disinclined to remove that naval blockade, which was part of the latest proposal received from Iran in order to reopen the Strait of Hormuz. So we see there that's where Brent crude has been sitting. WTI continues to climb up 1.5% there. Sydney futures are looking like we indicated towards an 8 session of losses. Well, Treasury 10-year yields in the meantime hitting a one-month high after a divided Fed held rates steady, signal that the Iran war is clouding the economic outlook. The meeting revealed a deepening division over the policy outlook. 4 officials dissenting. Fed Governor Stephen Moran called for a quarter-point rate cut. 3 then objected to the language that the Fed will eventually resume cutting rates, suggesting a hawkish tilt.
The 3 dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing?
Let's unpack the details of that decision. Our Fed reporter, Maria Eloisa Kapura, and our Bloomberg MLive strategist, Mark Cranfield, join us now. Maria, let's start off with you. How unusual is it in really the history of what we've seen in terms of Fed decisions to have this level and this balance of dissent happening?
Even though since last year we have been seeing this growing number of dissents, but it had been a while since we saw 3 dissents that were around language, and that's the case of the 3 regional presidents, Beth Hammack, Rory Logan, and Neil Kashkari. The 3 of them voted not against the rate decision itself, but the language of the statement. We have been seeing a discussion among Fed officials on the bias of the statement as it is. There's a lot of people who still believe it has an easing bias, so meaning that the Fed's most likely next step is still going to be a cut. And we know that in central bank world, every little word matters. So I feel like these dissents that we saw today really reflect the discussion that had been happening for the past 2 meetings inside the Fed regarding of the language of the statement. And yeah, there's a lot of officials that still believe that there's so much uncertainty given the war in Iran and its impact on inflation and the economy that the Fed needs to change the statement in a way that it's equally possible for them to cut or hike.
So, Mark, given what Maria Luisa is telling us about the nuanced dissents, right? We had only Stephen Myron actually voting to cut rates. How is this informing the markets? A reaction in the Treasury space was interesting.
Yeah, I mean, really, what the dissenters are telling you is that they feel that the inflation outlook should carry much more weight. So the reason why they don't want to maintain the Fed being on an easing bias is because they are expecting that this high oil price situation is going to feed in to the market for much longer and obviously keep elevation in terms of expectations of where the CPI is going to go for the US. Now, the Fed's dual mandate means that CPI is just as important as the jobs market, but for the time being, all the fluidity is in the inflation situation. And that's why the market, the curve flattens so much. Two-year yields jumped by the most for a couple of years at a Fed meeting overnight. And that's what traders are very focused on, is the fact that the chance for the Federal Reserve to actually lower interest rates, as Mr. Miron is asking for, but he always does, he asks every meeting for that, is extremely unlikely in a scenario where oil prices are above $100, and it is likely to last for longer. Now, you've got other central banks coming up as well. European Central Bank, Bank of England are probably going to come up with similar scenarios. Their outlook is also going to be very focused on what that war impact on oil means for the long term. The Bank of Japan already this week gave big hints that they're very concerned about it. So everybody knows that. The Fed would look like a big outlier if they completely ignored the situation in relation to oil. And that's what those Fed people, those voices are putting it back into the marketplace and telling you, yes, we are looking at it. Even though we're supposedly in an easing bias, we don't see that as being practical. And for now, we're definitely on hold. Market understands that, with the potential that if this situation goes on a long time, we may even need to go to a rate hike.
Maria Luisa, as Mark mentions, a pretty complicated situation, especially for the prospects of any consensus under a new chair. We saw Kevin Warsh now advancing in that key Senate Banking Committee. What could he be facing if he becomes the next head of the Federal Reserve?
Well, it definitely feels that it's a very difficult committee, the one that Kevin Warsh is coming into, and it's going to be extremely difficult to deliver rate cuts right away. First of all, as Mark was mentioning, the economic data, inflation is about 3% after the spike on energy prices caused by the war, and the jobs market only now seems to be finding its footing. So the economic data is still very much mixed and is still forcing the Fed to stay on this holding pattern. But also the dissents we saw today, what they reflect is a very divided committee around their communications and possibly around their future next steps. It's going to be very challenging for Kevin Warsh not only to deliver any rate cuts, if that is what he still favors, but also it's going to be very interesting how he starts to build that consensus on other things that are important to the Fed, on other reforms that he has touted he wants to do during his time as chair. He has talked about a regime change and change in the way the Fed thinks about inflation, change in the way the Fed communicates. All of that is possibly either going to need votes by the committee or at least support. And right now, as we were saying, it's a very divided committee.
Mark, it's interesting that division, the views when it comes to the dissent, the widening gulf when it comes to forecasting what the energy and inflation picture might look like going forward. Does that eventually still mean support for the dollar? Because we've also seen the big decline in the yen.
Well, that's very much the interaction between Treasury yields and the path of the US dollar. In the background is the oil price as well. We're almost going back to the situation that we saw in March, where every time the oil pushes higher, yields push higher, and the dollar pushes higher as well. The outlier at the moment is the equity market. That's holding up much better than it had done in March. But in the very short term, there's no doubt that traders are very focused on incremental shifts in yields being positive for the US dollar. And as you mentioned, dollar yen is already above 160, which puts Japan in a very awkward situation here. They've got a big dilemma here. When do they choose to start supporting the yen aggressively? With no doubt today we're going to get a slew of jawboning from the finance ministry and anybody in Japan who has something to say about the yen. That's not going to be very effective. We've seen the markets have become almost numb to the wording coming out of Japanese officials. What they want to see is action, but at what point is there going to be so? We saw dollar yen get pretty close to 162 2 years ago, and that's more likely if they do want to intervene to support the currency. It would make much more sense to wait until we see closer to the historical highs, because at the moment, although the traders and speculators are a bit short of there, it's not the same extreme levels that we saw 2 years ago. They need the market to be very short, and then it will be effective when they come in to sell dollars and buy yen.
Bloomberg's Mark Cranfield there with great insights. Also, our thanks to Federal Reserve reporter Maria Luisa Capurro. Right, and of course, a big story today also tech. U.S. mega-cap tech stocks under scrutiny as heavy AI spending delivers mixed results. Meta shares fell as a higher spending outlook reviving concerns as massive AI push may not pay off. Microsoft's cloud growth narrowly beating estimates but failing to ease investor worries about capturing AI demand. Alphabet, meanwhile, topping forecasts. Strong Google Cloud growth signaling its vast AI investments are perhaps beginning to deliver. Let's bring in Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. Mandeep, so we had idiosyncratic results, lots of results to go through. But at the same time, it seems the underlying narrative is one about whether or not all of this spending around artificial intelligence is actually paying off. So who's winning?
I mean, clearly in this case, Google seems to be winning. And look, I think overall, these results are very good for that CapEx spend because all of them are growing top line growth, over 20%. And, when you see AWS numbers increase sequentially to 28% at a $150 billion run rate, Google Cloud, 63% growth for $80 billion run rate business. It's amazing. And so that ROI that people were questioning around AI spend is definitely getting reflected in the hyperscale results. You could argue, the difference between Google and the rest of the peers was Google is the most efficient when it comes to the CapEx spend, which is why they didn't have to raise the CapEx compared to Meta and Microsoft, where they attributed the CapEx raise to increased memory costs. So from that perspective, Google's efficiency in their CapEx is really helping their margins, and that's why you see that kind of stock reaction today.
And it was both expanding costs as well as declining user numbers for Meta, right?
Well, I think had it not been for the increased, CapEx guide, the stock wouldn't have reacted negatively. So, at the end of the day, Meta increased their top line 33%. And it was a very impressive quarter in terms of ad pricing. So I wouldn't make anything else in terms of, being a negative other than the fact that in general, investors don't have a good clarity on when Meta will start monetizing, agentic AI, because they don't have a separate cloud business like all the other hyperscalers do. So just that lack of clarity around the timeline for AI monetization is why you see that negative reaction for the stock.
Same for Microsoft. What's going on? Because results seem pretty strong.
Look, Microsoft's, 39% growth is compared against Google Cloud growing 63%. And yes, Microsoft is raising the guide for CapEx, but how much of that is being attributed to memory costs again, and how much will reflect in cloud business accelerating over the next 2 quarters? We didn't get that clear sense on the call. So from that perspective, I think Google, because of its efficiency and the ability to show that sequential growth in the cloud numbers, has emerged as that clear beneficiary, of gaining market in cloud when others seem to be growing very well. Both AWS and Azure had great quarter in terms of growth rates, but it's not a sequential acceleration like we saw with Google Cloud. And it seems like Google Cloud is winning market share right now when it comes to AI workloads.
Great to have you with us, Mandeep Singh. They're joining us from New York. He's the Bloomberg Intelligence Global Head of Technology Research. And of course, we'll be following all of the tech stocks in the Asia session as well, especially since we have Samsung Electronics that's coming up, set to report final first quarter earnings within the hour. We break down the numbers ahead. This is Bloomberg.
Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate.
Fed Chair Jay Powell there speaking after the FOMC's decision to leave its policy rate unchanged. Let's bring out Jeanette Garretty, who's a chief economist at Robertson Stephens. And Jeanette, it was such an interesting meeting for a number of reasons, right? The fact that Fed Chair Powell has decided to stay on, that's pretty unprecedented, but also even just in terms of the widening gulf on the outlook for inflation, for energy prices and the war. What did you make of everything?
Well, the dissent was very interesting. The interest rate decision itself was kind of ho-hum here. But the dissent is what obviously caught everybody's eyes. And I think it's also the fact that the three people dissenting were, sort of not the usual vocal dissenters. And they're all Fed presidents from, if you will, the heartland. Does that predispose them to look at inflation in a little bit of a different way? Possibly. But the fact that it was a dissent over the language is almost in an odd way goes to the heart of something that Kevin Warsh, the soon-to-be new chair, is sort of put out there as something he wants to address. It's about communication. He has a very different view of communication. I think he might say, well, this is kind of nuts if we've got people dissenting because of the tilt in the language from one FOMC statement to another. That's not really what it should be, because it's not clear at all. It's not explicit. The market has read this as being these dissenters saying something very different about inflation. But it's not really clear that that's the case, that they just want to take a more neutral position. So it is very much about communication. I know that the markets are reading into this, that they're a confirmation of where they are already at, sort of here in the United States at least, that there won't be a rate cut this year, but that's not clear to me. I think it still depends on, look at tomorrow, we're going to get GDP numbers. Thursday, United States time, we're going to get GDP numbers for the first quarter. We're going to get more inflation numbers. All of this is going to be highly interesting. And Powell put out there, he said, in the next 2 quarters, we should find out if we are correct in our, meaning the Fed, judgment that the inflationary impact of tariffs is going to fade away as a one-time event. I think that might be some of what the bond market is listening to, quite frankly, because they're saying, oh, that means they might not see it. There might be something else going on that is a concern about inflation. I think that has been overlooked in the statement that he made.
The other interesting thing, of course, which is unprecedented, is Chair Powell's decision to stay on as the governor. And he said essentially that he was left with no choice but to do that, and that he would be sticking around until the threat of the criminal investigation has truly passed. But take a listen as to one of the many kind of very frank comments he gave about the risk of losing the Fed's independence and the risk of political interference.
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about.
Jeanette, the term shadow chair kind of typically refers to an incoming chair of the Fed, right? But do you think this is a role that perhaps gets assumed now by Fed Chair Powell, even if he is sort of a very low-profile governor?
Well, yeah, he said he wants to be there to guard, if you will, the independence of the Fed. Him staying on means that Stephen Mirren goes off. And I think that's significant. It changes the weight and character of the Fed itself, of the board itself. So I think that's significant. When I was playing back the press conference in my mind afterwards, one of the surprises I had myself was that he made the statement that he was going to stay on right up front in the press conference. I sort of thought he might introduce that 2/3 of the way through, or maybe even at the end. And I realized he may have done that because he really, really, really wanted to talk about Fed independence. I think he wanted that to be his legacy statement to the press corps. And it showed how strongly he felt about that. But he's been talking about that for a few months now, certainly since the legal actions or the threatened legal actions. But even at the end of last year, he has a deep-seated pride in the people and in the institution. And I think he will, personally, I think he will do it in the right way by staying on the board, and it will not be disruptive. But I think he feels he has a right to stay there and help the Fed retain appropriate levels of independence.
So, Jeanette, when it comes to the U.S. economy, where are we on inflation? I know that nobody wants to use the infamous transitory word, but if we get past the war in Iran, is inflation actually being reined in?
That is a much bigger question right now, Shery, than it was a couple of months ago, I think. And for the first time, and I'm starting to see economists and others really raise this issue of is this all just tariff related? The non-energy spike. Powell specifically mentioned not all of the inflation spike or the level of inflation that is too high, that is elevated, is attributable to energy spikes because of the war. But is it just that? Or is it in fact that businesses are passing along price increases because they can? If it is that latter, then the Fed is looking at something very different than they were expecting.
Jeanette, so great to have you with us. We appreciate your time. Jeanette Garretty, Chief Economist at Robertson Stephens. We have more ahead on the Asia trade. This is Bloomberg.
We're watching Samsung. Their preliminary numbers saw a 755% increase in profit. We'll get the final numbers next. This is Bloomberg.
President Trump told Axios that he would not lift a naval blockade of Iranian ports until he secures a deal with Tehran to address the country's nuclear program. Trump said he rejected a recent proposal from Iran to reopen the Strait of Hormuz, extending the standoff that's caused a global energy crisis. For more, let's bring in our Bloomberg Deputy Bureau Chief, Laura Davidson. So, Laura, we remain at this sort of standoff, right, where neither side seem particularly to have the sense of urgency anymore. And we know there's a high level of distrust in these negotiations.
Yeah, we've we've really hit this point where we're almost negotiating in slow motion here. Iran came to the table earlier this week with a proposal that would essentially just focus on the Strait of Hormuz. If the U.S. were to end their naval blockade, then Iran would open up the strait. Trump, several days later, then rejected that, saying that he would not remove the naval blockade unless there was a big deal that also involved Iran's nuclear program. This raises a lot of questions about, if there's, any sort of, short-term solution here, or if this is only going to be a long, drawn-out negotiation. We also see Trump, according to some Axios reporting, looking at doing some more targeted military strikes in Iran. We've heard that before. He backed off of that plan, but this is still something that's under consideration on the U.S. side. He has also reportedly told Netanyahu that he could consider these surgical strikes, no widespread strikes, but surgical strikes in Lebanon. So we could, see things tilting back towards military action as these diplomatic talks fail.
And at the same time, there's still a lot of criticism from Trump's detractors that saying this was a war that didn't need to happen now, and it's a very costly war, and we've got the numbers from the Pentagon to really back that up.
Yes, this is, Secretary Hegseth was on the Hill today in Washington testifying about the budget request that he has, which is this massive budget increase. One of his aides who was there said that the war has so far cost about $25 billion. There's a lot of doubt about that number because some early projections would have it suggesting that it's perhaps 2 or 3 times that at this point, 2 months into the war, which is raising a lot of questions about both the honesty coming from the Pentagon about the size and scope of this war, but also what sort of a suspended quagmire would mean for the U.S. The Pentagon has requested a really massive budget increase for the next fiscal year. That's drawn criticism of both Republicans and Democrats. Unclear they're going to get that kind of money, but to kind of see this war out, they may need that, and this really just will detract rather from the public support for this war, which is already really at a low point. Putting Trump, his administration, other Republicans, on their back foot as they try to defend why they need to be involved in this and why they need to spend that kind of money.
I see President Trump has also said that they're potentially going to look at reducing troops placed in Germany as well. But amidst all of this, $25 billion for a war that is not popular, I do wonder how that feeds through to the voter psyche, right? At a time when a lot of people, just want affordable groceries and gas bills.
This is really something, we have not seen before of, the level of Republicans breaking support with the president. There's always going to be about 20-25% of Americans who support Trump almost no matter what. That's what we've seen through the 10 or so years that he's been in politics. But we're starting to see some of those independent voters or some of those voters who were less loyal to him specifically and more just like some of the policies, particularly economic policies, have started to break away, saying that they didn't want to be involved in foreign entanglements. They didn't want U.S. taxpayer money spent overseas, and they wanted to be able to have lower prices for grocery and gasoline. We're seeing the exact opposite just really within the past 2 months, as this war has been underway.
Right, Bloomberg's politics editor Laura Davison there with the latest on the war in Iran. Of course, no clear exit path there, so we continue to see the gains when it comes to oil markets. U.S. crude opening higher, up for a 4th consecutive session. Brent also at the highest level since 2022 and very close to that $120 a barrel level. For more, let's bring in Steven Sapchinsky, who leads our Asia energy coverage. Steven, how tight are physical markets right now?
I think we're getting to the point where there's less and less of a buffer. So let's go through it. A lot of the floating storage that was on the water has been taken away. There were sanctioned Russian and Iranian barrels that were on the water. Also, that has been drained by buyers in Asia that received waivers. You've got U.S. Oil exports reaching a record high last week. But that, again, is draining inventories at home. This is not sustainable the longer this goes on. The U.S. cannot replace what is being lost from Hormuz. So I think the market is reacting to just the physical supply and demand situation. The levers of demand destruction in Asia, especially from emerging countries, has been pulled. The floating storage has been pulled. The U.S. exports have been pulled. What else is there left beyond now the developed world reducing demand? That we're talking about the United States, we're talking about Europe, and that will really start to hurt. And there's only so much demand that you can reduce. So that's why we're getting back to the highs of the war. And I think there are fears that the longer this goes on, you could see this continue even higher.
We're hearing now that Iran is running out of crude storage as well. Could they be forced to shut down production? And I guess the long-term question is, if the Iran war ends, how quickly can these production sites be ramped up again?
This is a game of chicken. because ultimately it is how much pain can Tehran withstand in terms of the limits that they can send for their oil. If there's the blockade, they have to reduce production. That reduces the amount of money that they get in their coffers. At the same time, the Trump administration doesn't want $5 gasoline for consumers right before the summer driving season, especially in a midterm year. That all being said, let's look at the storage situation. The Trump administration and Trump himself has signaled that there are just days of storage available before it all fills up if they're unable to get their ships through. But on the opposite side, Iran has kind of said that they could do this for longer. Looking at what the analysts say, Kepler estimates that there could be more than 20 days left of storage before they really have to reduce production. The thing is, if you kind of take a step back from all of this, this isn't Iran's first rodeo. They've had to deal with disruptions, sanctions. They've had to deal with them having to reduce output. So them doing it is possible, and they have the ability to do so. In terms of ramping it back up, I mean, the big question is not so much how fast can they ramp it back up. The question is, how many ships are they going to be able to get through if there is some sort of ceasefire or peace deal extension? Because the fact of the matter is, they're just not getting enough ships out. And will the U.S. hold a presence here?
Stephen Sarchinsky, really good to have you with us. He leads our Asia energy coverage. We have more ahead on the Asia trade. This is Bloomberg.
Some of the tech headlines that we're watching this hour, and Qualcomm shares jumping in extended trading after the chipmaker said it's making progress in the lucrative data center market. The company said that a top hyperscaler was on track to begin using its chips later this year. Qualcomm also sees a rebound in its biggest market, China. It expects the country's smartphone sector to bottom out in the third quarter and return to sequential growth. Sources tell Bloomberg that Anthropic is considering a fresh funding round that would value the company at more than $900 billion. The AI developer is said to be entertaining investor interest that could more than double its current valuation. The talks are in an early stage and no offers have been accepted, but the move would allow Anthropic to leapfrog rival OpenAI to become the world's most valuable AI startup.
And we do have an alert on the Bloomberg right now. We are now hearing from the Financial Times that SoftBank is planning to create and list an AI and robotics company, Rose, in the U.S. that would be involved in building data centers. Rose could be listed as early as this year, according to the Financial Times. And executives at SoftBank are eyeing a valuation that could reach $100 billion. And of course, we continue to follow the latest after-hour moves from the U.S. tech giants that have reported results. Alphabet, for example, continuing to soar more than 7%. They had pretty strong results, and basically the consensus being that perhaps they are finally seeing the payoff of their AI investments. We're seeing a little bit of a mixed picture with Meta really dragging right there. Their CapEx spending raising concerns about really the sustainability and the payoff as well. Let's actually discuss all of this and bring in Maribel Lopez, who's the founder and principal analyst at tech research firm Lopez Research. Maribel, great to have you with us. Is it all about really the CapEx story here, and what stood out to you when it came to that drag in their numbers?
Yeah, when we look at what's happening, AI rises all boats, but it also is one of those things that's very difficult to get over the CapEx wave. So what we've seen happen is almost everybody is coming in with well over 100 billion in CapEx spend. You know, we're looking at 190, 145. Really hard to see when the revenue hits to match that CapEx spend right now. So that's the thing that Meta's experiencing right now. There's waning interest in the belief that they actually have the right AI to gain that money, whereas you see someone like Anthropic and even OpenAI starting to make real strides with that. So the CapEx thing is a thing that's also killing the Microsoft earnings. You know, by all standards, they had a great quarter, but people just don't believe that their AI revenue is going to keep pace with their AI spending.
A different story for Google, though. Is Alphabet the one that right now we're seeing the capitalizing of all of these AI investments?
Yeah, if this were a horse race, we'd be calling Google the closer right now, in the sense that everybody thought that they were extremely behind in terms of whether or not they were a leading cloud provider, whether or not they were a leading AI provider. And now it turns out that everybody's turning around, looking around and saying, hey, they seem to be having really good AI revenue, really good cloud growth. They're coming on really strong. And they're coming on strong at a time when we're actually starting to see enterprise buyer interest in both cloud and cloud AI together. So it's a really good time for them to have this hit. Whereas the other companies, if you look at Microsoft, people feel like their big wave has passed them by. And even though they seem to be growing really at a good rate, the consensus just feels like it's not enough. They thought that they should be growing more. Whereas Google came in, they thought they were going to be growing less, and they're growing at a better rate than people expected them to. So that's what I think we see as some of the disrupt in the numbers that we're looking at right now. By most standards, with the exception of Meta, we could say that everybody did really well this quarter.
When it comes to Meta, though, they attributed that CapEx overhang also to more expensive component costs, right? How much does this become more of a broader pressure point, particularly as we take a look at the expense and the sort of lack of flexibility in terms of supply chains as this war drags on too?
Yeah, this is where we get into the real interesting thing of how, do you have a chip game and how advanced is your chip game? So if you look at Google, they just announced new TPUs last week at their conference, and that really, they made a very big point about how that was going to help them on the cost side. AWS and Microsoft have both made similar moves. So not everybody is so dependent on NVIDIA in that regard, and that gives them a little more flexibility in terms of what that operating expense is going to look like and what the CapEx is going to look like for them. So I think when we look at Meta, the biggest issue with Meta is they're going to spend a lot on AI, but we're not quite seeing where they're going to make the revenue. Is it going to be on ads? Is it going to be on frontier models? They seem quite far behind in the frontier model game. They've made some acquisitions. There have been some difficulty with those acquisitions lately. So really, it's a very troubled time for Meta in terms of understanding how that AI strategy comes to fruition. Whereas if you look at the hyperscalers, it's pretty clear what happens. They're going to sell cloud workloads based on AI. They may sell AI applications and agentic software and other things on top of that. So the revenue picture for them, while not clear, you can actually see a path to growth for them, where it's much harder to see a path to growth to Meta, where they're spending a lot of money on capital expenses for AI.
The investor reaction seems quite binary in that sense, right? Either the spend is warranted or it isn't, and that's a cycle we continue to see these broader markets go through. And for Meta, as you kind of allude to, it's a matter of, well, you're spending this money, and are you going to be a market leader? And there are doubts on that. What do you see in terms of the competitors in this space, right? Because we're hearing that internally Google is very worried about the likes of Anthropic.
I think everyone's worried about the likes of Anthropic. They've made a really much stronger play in the enterprise than people thought they were going to make. They have been very focused in terms of what they're doing. If you look at OpenAI, they have things like Sora, and then they shut down Sora because video spends a lot of tokens, but it doesn't really get you a lot of money. So the question is not, can you develop AI? The question is, can you monetize AI? And I think that's one of the things that when people look at what Anthropic's strategy has been, people love cloud code. People are coding. There's all this discussion about the demise of software engineers, which I don't believe is valid. But even having said that, they're selling into enterprises. They have healthy, strong enterprise revenue. So people are more willing to give them a pass on the CapEx spend because they can see a path to growth, because we're really at the early days. We are nowhere near at the point where we could say AI has mass penetration in organizations. So there's a lot of runway for the right companies.
Is there room, do you think, for the right companies? Is there room for both an Anthropic and an OpenAI? We're hearing now that Anthropic is looking at a new funding round, offers at over $900 billion in terms of its value.
This is not a Lord of the Rings moment. There's not going to be just one. It's impossible for there to be just one AI company that rules it all. So I think there's opportunity. I think there will be a tremendous amount of competition, and I think that people will continue to pick their tools just the way that there was room for more than one cloud company. I believe there's room for more than one AI company. So I think we're going to have a healthy set of competition moving forward. And I think part of the bigger issues for all of the smaller, more specialized companies, how do they continue to drive value? And will they just end up rolled up into something like an Anthropic or an OpenAI?
Maribel Lopez, really good to get your insights, principal analyst at Lopez Research. We have breaking news out of Samsung. We're getting the final first quarter results. We are seeing net coming in at 47.1 trillion won, which is much bigger than estimated at 38.29. We're also seeing their breakdown of their divisional operations. Mobile chip operating profit, which is the more important one, of course, 53.7 trillion won, and this is also beating estimates. When it comes to chip sales, 81.7 trillion won, also beating estimates. This brings about the operating profit at around 57.23 trillion won. Now, these numbers are exponentially higher than previous quarters. We're talking about a 700% plus increase in profit in this March quarter alone. This would be a record for Samsung as well, at a time when memory's contribution was estimated in their earlier earnings to be close to about 90% of total operating profit. We're now seeing the net come in at 47.1 trillion won. You can get more on the biggest stories in tech on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia and other shows on Bloomberg.com/videos. More ahead on the Asia trade. This is Bloomberg. We are getting the latest industrial production numbers out of Japan. We are seeing right now month-on-month a contraction of 0.5%. This is a preliminary number. Year-on-year, still growth of 2.3% and exceeding economists' expectations. We were likely to see a pickup in the month of March, given that we have had solid AI-related demand. We're also getting the latest retail sales numbers, and month-on-month is up 1.3% for the month of March. Year-on-year, 1.7%, coming in stronger than economists' expectations, despite the fact that we continue to see, of course, inflationary pressures in Japan, topping that 2% BOJ target for the past 3 years. Haidi?
Yeah, Shery, let's get you caught up when it comes to some of these headlines that we're watching on the corporate front this hour. And Ford has lifted its full-year profit guidance, citing strong demand for high-margin pickups and SUVs that will help offset a sharp rise in commodity costs. That updated guidance also reflecting a $1.3 billion one-time tariff relief in the first quarter. Ford cautioning that the outlook does not include risks from a prolonged Iran war or a US downturn.
The forward curves are still holding that this Middle East situation is going to be more on the short-lived side. You know, as a result, at this point in time, we are believing that there's going to be some recovery as we start to exit Q3, as we get through Q3 and Q4.
China's largest banks posting an uptick in the profit growth for the first quarter, signaling a potential turn for the industry. Most lenders benefited from the recovery in fee income, tightened deposit rates to protect margins too. Net interest margins and non-performing loan ratios remain broadly stable. Morgan Stanley is forecasting a revenue recovery as margin pressure eases and fee income stabilizes. Singapore's largest bank, DBS, reporting first quarter profits largely in line with expectations. Net income rose 1% year on year to $2.3 billion. Wealth management fees surging 25%, offsetting the weakness in net interest income. CEO Tan Su Shan says the lender had a strong start to the year despite continued rate and geopolitical headwinds. Well, let's get you back to some of these Samsung numbers that we had previously, and that first quarter net as a headline, Shery, beating estimates. The first quarter beating the average analyst estimate. We're seeing 47.1 trillion won for net. The estimate was for 38.29 trillion won. Operating profit coming in at 57 trillion won there, and the chip operating profit, if you split that out, at 53.7 trillion won, also better than expectations of just over 40 trillion won there. We saw the consumer electronics operating profit also better than expectations. Display, a little bit of weakness there in the mobile networks number. Just missing estimates, but not by a lot. But clearly this is a story that continues to be driven by the semiconductor cycle. We're hearing now, Shery, from Samsung, talking about the plan to deliver HBM4E samples in the second quarter. They expect server memory demand to remain strong, agentic AI to accelerate growth in demand in the second half too.
Yeah, the memory demand is key here, right? I mean, we saw that the memory contribution was estimated to be close to 90% of total operating profit. And we know the memory prices have remained very strong. And of course, we have a slew of positive news for Samsung as well. We have heard from local media that NVIDIA was mulling physical AI collaboration with the chip maker. And we have also seen the Samsung has showcased their cutting edge HBM4E chip at NVIDIA's GTC event last month. And as you mentioned, that HBM4E samples will be delivered in the second quarter. No wonder, if you take a look at this chart on the Bloomberg, you can actually see that Samsung is now trading at 5 times earnings. So you have this huge boost from the earnings side with, of course, the memory shortage. And now you have forward PE being driven down. So we'll continue to watch Samsung at the open as, of course, we're headed towards South Korean and Japanese markets. Japan coming back from holidays at a time when we've had a little bit of a mixed picture. We have to digest not only the latest mega cap tech earnings from the U.S. side of things, of course, that has big implications for suppliers across Asia, but at the same time, we do have to contend with the FOMC decision that was perhaps perceived as a little bit more hawkish. But the Kospi has held at record highs, and you can see right now futures pointing to some upside, and Samsung Electronics could be a big contributor of that. And Nikkei futures right now pointing to downside. Of course, Haidi, the issue, the Bank of Japan, what they're expected to do. We have now seen the 10-year yield surge to a 1997 high.
Shery, it's so fascinating when you sort of chop and change the ways that you can look at the impact of Samsung on this one market, on this one economy, right? The economic influence, the sheer dominance of this conglomerate. If you take a look at the 7 key Samsung affiliates, including electronics, equivalent of just over 19% of South Korea's GDP in 2025. That's up from 15% a decade earlier. So that influence continues to grow. As we head into the start of trading the Kospi, just remember, Samsung Electronics is roughly a quarter of that index. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after the Fed rate decision. Pretty much expected, Haidi. They held steady, but the divisions within the FOMC growing 4 dissents this time. And of course, for Asian markets, we also have mega cap tech earnings from the U.S. to contend with.
Just that widening gulf when it comes to inflation expectations, what happens with this war, and again, the widening gulf when it comes to what tech names are doing versus the rest of the market, right? Shery, also pretty extraordinary that we saw Chair Powell really remaining quite resolute, saying that he'll stay on as a governor until such time that essentially he can assure Fed independence.
Yeah, so we will continue to watch, of course, the Federal Reserve, as we have seen Kevin Warsh also win that key Senate Banking Committee vote, and that moves to the full Senate as well. Here in Japan, we're very much focused on the latest from the Bank of Japan because we continue to contend with the implications for the Japanese yen. We're talking about having surpassed that 160 level and headed towards the weakest levels against the U.S. dollar since 2024. So at any moment, we are expecting perhaps authorities continuing to have more strong rhetoric in order to support the currency. Take a look at how Japanese stocks are coming online. We're seeing a little bit of downside. Of course, we are watching some of those tech earnings that we got in the overnight session. Some of those names very much correlated with equipment makers in the semiconductor side of things here in Japan. So do watch out for the likes of the Vantest, Disco as well. You can see the 10-year yield also continuing to surge as those expectations about BOJ rate hikes hikes continued to get pushed back. We're talking about 1997 highs. Take a look at how Korea is coming online. Of course, we had Samsung's final results. We're talking about profit, a 48-fold jump. So you can see right now Samsung continuing to gain ground, SK Hynix also advancing. It's really the memory conversation, the shortage that's really leading to that boost for these tech companies. And of course, the ongoing demand around artificial intelligence and all of that CapEx spending from hyperscalers that we saw in the overnight session from those mega cap tech earnings. The Kospi still holding to record highs, Heidi.
Shery, take a look at what we're watching when it comes to the bond reaction to that Fed. It was such an interesting meeting, as you say, just that widening descent. The comments that we heard from Fed Chair Powell in his last press conference, but of course he will be sticking around as a low-profile governor, but that in itself has really gotten a reaction from the White House as well. But Treasury slumping, two-year yields in particular rising the most on that decision day since 2022, since any Fed decision day since 2022. Really the bets that the bank may need to raise rates amid these persistent inflation pressures. This idea that perhaps these pressures are not transitory are starting to come back into play there as well. We're also looking at, of course, that support that we continue to see for the dollar. Shery just mentioned the yen side of things, but also is playing out when it comes to the gold price as well. A lot of this also coming down to greater uncertainty as to really no clear picture as to what the off-ramp is for the US-Iran war. We're hearing that a lot of talks have been held between commodities and military chiefs about extending that naval blockade. There's been really no move yet in terms of any kind of increase of flows through the Strait of Hormuz. Vessel passage has essentially been reduced to near zero as oil prices, as you can see on your screen, continue to be extended. We're also seeing that further downside with the energy-heavy Australian market now on track for an 8th straight session of losses. But take a look at what we heard from Chair Powell in his final press conference.
The three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing?
Our executive editor for Asia Markets, Paul Dobson, joins us now. Paul, such an interesting meeting in terms of just the disparity that we see in that dissent.
Yeah, good morning. You can see pretty much whatever you want from that Fed meeting, but it does seem like the center of the policymakers' view is shifting more towards neutral and less away from that dovish bent that they had been maintaining. And yes, okay, so Powell was saying they didn't necessarily feel that it was the right time to vocalize that as a group, but certainly, the idea that there are dissenters gives that away. I mean, what's really important here, what was really important for yesterday's markets as well, is that crude oil price, right? That's the thing that everybody's keeping their eye on. Really, that's what's going to be driving those long-term inflation expectations. That's what's causing central bankers to think twice about the policy path that they'd been on. And yesterday on the front month Brent crude, we hit a new high for the war and for this year. And I think that speaks to the increasing worry that we're going to get to a point where we're really going to be scarce of supplies now, with the idea that the US is not going anywhere with that blockade.
Yeah, I mean, Paul, no wonder we're seeing traders on top of course, what we heard from the FOMC and just digesting all of that, pushing out all of those potential rate cuts, even pricing in the risk of rate hikes. And you can see that it really clearly reflected in the Treasury space. The 30-year now surpassing 5% again.
Yeah, so it's an interesting dynamic. I mean, yeah, the 30-year yield getting higher, and that's those inflation expectations getting built into longer-term forecasts. But the bigger move, as you've been saying, yesterday was at the front end of the yield curve where we saw that bigger jump. And so the idea is that people are pricing in the idea that maybe the Fed will move towards a hike perhaps next year. Maybe other central banks will move towards tightening policy. So automatically that pulls in a little bit those long-term inflation expectations if you are going to have higher short-term interest rates. So what we actually saw was a little bit of a flattening of the yield curve, even though everything was rising across the board yesterday. And so I think that the other consequence and what we're going to have to be paying attention to, particularly for our markets, is that means a stronger dollar, and that means more pressure on Asia currency. So they've got this double whammy of the cost of crude oil going up, but also the dollar appreciating. And so that's hurting the yen, as we've been talking about already, and it's going to put South Asian economies, the Philippine peso, the Indonesian rupiah, the Indian rupee, all under mounting pressure again today.
And yet, when it comes to Asian markets, the divide seems to be growing larger, especially around all of the conversations around artificial intelligence demand.
Yeah, well, that's right. So those southern Asian economies that don't have the tech are ailing. But if you look at South Korea in particular and Taiwan and parts of the Japanese market as well, that's kind of veiled by the fact that the tech performance has just been so super strong. And because they're such an important part of the Asia-wide gauge and also of the emerging markets global gauge, which is on its best, month for, over a decade, that sort of takes away some of the downside from the parts of the economy that are going to get hurt by those rising oil prices, at least for now. And I think that, the readout from all of those tech earnings that we had from the US, when you net them out, yeah, there were positives, there were negatives. There's a little bit of a bifurcation in terms of the narrative. But overall, we have US futures up again today, and that does bode well for the Asia tech stack as well.
How much sort of further upside do you expect, given how far this rally has gone, particularly for a market like Taiwan, particularly for just the exuberance that we continue to see for Korean stocks?
As long as they keep delivering on the earnings and the sales growth, then that will keep those valuations rising, kind of or staying relatively stable. And I think that that's what the story that we've seen of the first quarter has been. Super strong earnings, super strong momentum, super strong demand for the memory chips from the South Korea in particular, but also from TSMC's chips. And so what we're actually seeing is probably more companies and more stocks in Taiwan joining in that rally as well. So I think that there doesn't necessarily have to be a top for tech despite the big rally and the momentum. There may be pauses along the way, but if everybody's reporting bumper profits, bumper demand, and you really believe in this global digital transformation story and the fact that we're going through like an industrial revolution type change, then yes, at some point there'll be discrimination between different companies as well. But no, that doesn't mean to say that necessarily it will run out of juice or turn around anytime soon. So that's something I think that, is that long-term story and long-term narrative really going to hold? It feels like there's a lot of momentum behind it.
A lot of momentum. There seems to be a lot of consternation over central bank policy risk at the moment too. We're just hearing from the Bank of Korea after an internal meeting in their statement saying that they see uncertainty on Fed rate policy direction is increasing. They'll be closely monitoring markets. With that dissent that we spoke about, with the broadly uncertain geopolitical environment and some of these macro triggers, the inflation environment really being a source of consternation for central bankers at the moment, do you see the risk of a policy mistake or policy risk generally heightened?
I think there's every chance because we just don't really know, what's going to happen with the energy pricing. And so if there were a peace deal tomorrow and crude fell off a cliff and everybody was happy that the idea that energy supplies would come back quite quickly, it's an if, it's not necessarily a base case scenario, then central banks would have to rethink again. And so that's why I think that it makes sense for the central bankers to be relatively cautious. And that's what you saw with the Fed. It's not a big lurch. It's a little bit of a shift and a little bit of a change without actually having to act right now. So unless you see sort of too much aggression from the central banks, they sort of need to be that little bit more patient and a little bit more careful about it. Now, the risk on the other side is, the transitory trap that we saw a few years ago where people think, the oil price shock will only be temporary, but it actually starts to feed through into the second round effects in the economy. So people want to watch out for core inflation as well to see how that's feeding through. And that may, in the end, be the thing that decides which way the central banks go.
Our executive editor for Asia Markets, Paul Dobson, there with a lot for investors to contend with. Another one that is in focus at the moment is SoftBank. At the moment, we're seeing SoftBank Group shares falling as much as 6% in the first few minutes or so of trade. And this sort of concerns over CapEx spending, the Rose issue there as well. SoftBank is set to create and list the AI firm Rose in the US, according to reporting from the FT, aiming to list at a target valuation of $100 billion. Master is driving that effort, and of course we know that SoftBank has really stepped up their investments in AI, including that $3 billion Digital Bridge Group deal, the $6.5 billion purchase of Ampere Computing as well. Well, coming up, Japan Exchange Group's profit surged 30% in its latest results. We have an exclusive interview with the CEO, Hiromi Yamaji, in Tokyo next. This is Bloomberg.
Japan Exchange Group's profits surging 30% in the fiscal year that ended in March. And Bloomberg Intelligence now thinking it should post another 14% rise this year, thanks to Japan's active cash equity markets and rising interest rate swap income management. Joining us exclusively now is Japan Exchange Group CEO Hiromi Yamaji. Great to have you in studio.
Well, thank you very much. It's the first time, yes.
We've been here for 2 years now.
Yeah, I know that. I have been rejecting it.
No, but you've come today, and
Yes.
I think it's at a time when your business is doing very well. So what's driving this surge?
Well, at this moment, as you said, that the global investors' interest over Japan or Japanese market quite high, and we are trying to continue our efforts to improve the corporate governance of the Japanese companies, and which also attract the global investors. So it's a very good virtuous cycle to attract the global investors and the more improvement of the corporate governance kind of things. I think, however, we are still on the way. So we will continue to do our initiatives in the future.
It's great to hear some optimism coming from our guests, because right now we're seeing so much uncertainty around the world. How concerned are you that the virtual cycle might be disrupted, especially when we don't know when the Iran war could end?
Yeah, that's, global uncertainty impacted global markets, that's for sure. And some of them are not under our control at all. So what we can do is that we will promote whatever under our control, which is, Japanese companies, corporate governance reform, and also to enhance the Japanese companies' resilience and the growth trajectory in the future. So that we will focus on it.
I mean, there has been a lot of trading momentum, which has helped for your business at the Japan Exchange. Do you expect risk appetite to take a hit if this whole geopolitical issue continues in the backdrop?
Well, I think, because the Japanese economy, as you know, we are getting out of deflation. We have been suffering from deflation for more than 3 decades. And under the deflation, as you know, the cash is king. So nobody, willing to take risks. But now, for 4th consecutive years, we have more than 2% of the inflation. That means that everybody, including individual investors as well as the corporate sector, household sector, everybody has to take reasonable risks. And the equity market is, providing them with a very good, return. So I think, they have more risk appetite than ever. That's for sure.
Well, the concern now is, will the Bank of Japan fall behind the curve, given, of course, the oil surge right now?
Well, I think, I'm not in the position to say anything on the policy-making decisions of the Bank of Japan. However, at this time, I believe that, that's a very notable thing is that 3 members of the policy committee clearly mentioned that they are against the decision, and Governor Ueda clearly mentioned that he is take it seriously. So I think I believe that they are watching the overall situation, and then will make a rational decision.
Bloomberg Intelligence thinking that your collateral management income could double if the BOJ delivers 2 25 basis rate hikes this year. Thoughts?
Yeah, well, it depends on the markets. Not the policy interest rate only. So markets will react, react to the decision of the Bank of Japan. And yes, if the market reacts in that way, that our positive income over the collateral management will be increased, that's for sure.
Based on how many rate hikes this year?
Well, I'm not sure, but I know. I think, even though, it moves every day.
Okay, and what's really moving right now, the Japanese yen, past 160 again. This actually helps foreign inflows, though, into the Japanese markets.
Well, yes and no, because, I think a stable exchange rate is the best way for attracting global money. And, weaker yen gets a lower, return for the global investors. And higher yen is a lower return for the global, higher return for global investors. Yes. But, I think, the stability is more important than volatility, the exchange rate.
When you're looking at the fundamentals of the exchange rate and you look at the Japanese economy, is it reflecting the fundamentals?
Well, my personal opinion is that 160 is too weak. I believe that should be higher.
Around?
Right, 140, 130, like kind of things.
Given the strength of the economy?
But it's well, yes, yes and no. Economical analysis is a bit difficult to mention here, but I think it's kind of my feeling is that it's too weak.
When it comes to the Japanese yen, we have heard from Finance Minister Katayama and all of those commentaries around it. We have seen rate checks also coming from the New York Fed, not necessarily moving it. And then you're thinking, is this actually speculation on the yen weakness side of things, or is it just the global economy? You have a strong U.S. economy as well.
Yes, I think basically it is dependent upon the strength of the economy, that's for sure. But at the same time, in the short term, volatility is not always dependent upon the economy, strength of the economy. And I think at this moment, maybe yen gets higher and lower and dependent upon the momentum of the market. But that's a market. I think that's a natural nature of the market, I think.
Given the backdrop right now in Japan, what are your expectations for corporate activity at a time when also Japan is very much exposed to Middle Eastern oil, especially when it comes to listing in Japan? Will it be attractive?
I think, yes, it is attractive for those companies who would like to take advantage of the listing status. And nowadays, as you said, number of corporate actions, including a record high number of M&As and record high number of PE fund sponsored, carve-outs, and also a reduction of cross-shareholdings. All of those kind of things are happening among those companies who believe, listing position is beneficial for them.
Japan is now the world's #2 when it comes to shareholder activism after the U.S. That's incredible. Do you expect that level of engagement this year too?
Well, I think, and as for the activism, we call them engagement funds, by the way. But I think, as a market operator, we are neutral about them, and because, in order to maintain the abundant liquidity, and also price discovery functions, we need every types of investors. But I think, generally speaking, external pressure can be used as a catalyst for default. And I think many Japanese companies are starting to see that engagement with the stakeholders can be used as a good discipline. I think so. I don't know, in the future, activism in Japan may be more active or not. I'm not sure. However, I think a number of Japanese companies have the potential to grow further, that's for sure.
You've really been an advocate for all of these reforms in Japan and have pushed the need for engagement with shareholders. You're, of course, trying to really finalize the Japan Governance Code as well, which is going through a revision. In that sense, how are you modernizing the Japan exchange as well? New products, new systems that might need to be adopted, and perhaps even some controversial assets out there, prediction markets, crypto as well.
Well, I think as far as the crypto is concerned, as you may know that at this moment, I mean, the Japanese FSA had a special committee to discuss about the crypto currencies, and I think the new revision of the law is at the diet. I think we will start forming some sort of a product of the cryptocurrency next year, maybe. So we will do it, and also other than that, I think prediction market, I think it's a bit difficult for us to adopt in Japan because criminal law kind of things, So there are only some of the horse races, like bicycle races, are allowed just because of the special law legislation on that. So if that's the case, we can do it. But then other than that, it may be difficult for us to start those kind of products in Japan.
And before I let you go, Yamaji-san, I know that you met with Finance Minister Katayama last week as well because of Anthropic's Mythos and other central bank governor Ueda as well as chief bankers. What was discussed and what are you expecting to do now?
Well, what we discussed is the detailed content of the discussion is probably, according to the government release. But I think the discussion was that we have to be prepared for new types of cyber attacks. And also especially by the Anthropic Mythos, cloud Mythos. And I think, we have to be prepared as an industry, not an individual company. And the government is more than happy to support our activities. So we will form up a kind of committee to discuss those kind of things in the future.
And you've reviewed Japan Exchange's vulnerabilities.
Yeah.
It's really great to have you with us.
Thank you very much.
Hiromi Yamaji, Japan Exchange Group CEO, it was really great to have you here in our Tokyo studio. We have more ahead on the Asia Trade. This is Bloomberg.
Take a look at really the Samsung effect, right? Not only is it the heavyweight when it comes to trading on the Kospi, it's also lifting up some of the other chip-related names, the likes of SK Hynix seeing upside of 1.4% there as well. Samsung Electronics itself seeing more modest gains, just over 1%. But this, of course, coming as the chip profit, the chip sector really reporting an operating income of 53.7 trillion won in the first quarter. That was a beat on estimates, reflective of the massive spending that we continue to see from hyperscalers on AI infrastructure, hundreds of billions of dollars going into data centers and other hardware. We do have these heightened expectations that Samsung's chip division will build on its own profit that's been really breaking records over the past few segments. Over the next few quarters, they're expected to go even higher. Contract prices continuing a pretty steep upward trajectory. Supply remains limited, and that really was reflected in some of the other earnings that we saw from big US tech, including the likes of Meta, saying that those component costs continue to go up. We're also looking at some other stories when it comes to earnings in the Japanese market. Fujitsu going the opposite direction, falling the most in 11 years after their forecast missed estimates.
We think our policy rate is in a good place. People are not saying we need to hike now. I don't think there's much of a case for any case really for policy looking, meaningfully restrictive, maybe mildly restrictive or neutral. I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. The things that have happened in the last 3 months have, I think, left me no choice but to stay. I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations, but we've had to fight for it.
Fed Chair Powell there saying interest rates are in a good place with no strong further case for more tightening. But really, it was one of the most interesting and nuanced Fed decisions and press conferences, of course, Fed Chair Powell's last, that we've had in recent times. Reaction that you saw across US sovereign bonds in treasuries was particularly clear as to these traders repricing these expectations as to when we might get more tightening. In particular, that 2-year yield jumping 11 basis points. This is the biggest reaction we've seen on any Fed decision day since 2022. We also saw some moves across the end of the 30-year end of the yield as well, reaching 5% for the first time since July. The dollar also climbing, getting support as this ongoing uncertainty over the US-Iran war, the fact that we still have a naval blockade, the Strait of Hormuz still very much closed, and that uncertainty over the inflation picture. The divisiveness that you see in that dissent was really what it came down to, with a number of hawkish dissents and some members of the committee of the FOMC really taking issue with the wording that there would be an eventual resumption of lowering of rates. So to that point, if you take a look at market pricing, we're looking at 50% for a Fed rate hike by the time we get to April 2027. So let's get more on this very nuanced Fed meeting. Our economy reporter, Enda Curran, joins us now in Washington. And Enda, we were talking to Paul Dobson, and he was sort of joking, saying that you could, whatever you were looking for in that meeting, in that press conference, you could probably find it. But was the dissent and the lack of agreement interesting to you?
I mean, there are many layers to unpack, Heidi, like you said. Just take the policy decision, no change as expected, but really clearly discomfort now among some of those on the FOMC at the moment in terms of keeping language around, additional easing could be on the cards at some point soon. Clearly, they want to send a message loud and clear that the Fed is in somewhat neutral zone. So pushing back against the prospect of a near-term rate hike. That's interesting in and of itself, but it's especially interesting given we're going to have a new chair now in a few weeks, Mr. Warsh, Kevin Warsh, who of course has kind of come to the job sort of painting something of a dovish backdrop. We know the political pressure on him to get rates down, so his starting point looks like it's difficult. And then, of course, within all of that, we had a subplot about Chair Powell signaling that he's actually going to exercise his right to stay on the board even after his term as chair finishes. He promises to keep a low profile. He says he won't be a shadow chair, so to speak, but clearly that's going to become a source now of immense attention for Fed watchers too. So lots to consider on the Fed policy side of things and lots to think about on the political dimensions here too.
And when it comes to the bread and butter of the expectations of transitory inflation, right? I thought that was quite interesting in terms of the expectation that the tariff-related inflation side may have been addressed by now, but there's still not a great deal of certainty over that, right? Because you've now got the added concern over the fact that supply chains are being threatened by the war.
A lot of confusion on the inflation outlook, I think, Heidi, to your point. I mean, during the press conference, Chair Powell said that how can we look through this energy crisis when it hasn't even yet peaked? And of course, they don't know how the war, nobody knows how the war is going to play out. And to your point as well, he flagged the role that tariffs continues to play. So they're really just, obviously they're hedging it, but they also don't yet know how the inflation story is going to play out. And that's why I think we had this shift among some policymakers who really wanted to push back, and they pushed back against the statement. That's where those dissents came in to make the point, look, we can't be signaling additional easing here, given the circumstances around us. And Chair Powell, who of course didn't want to be sending much of a new signal on policy in his last press conference as chair, because he's going to be out of that frame very soon. But even he said the economic outlook is so uncertain that things remain unclear as to where they will go from here. But it's all building and all adding up to a very complicated picture for Mr. Warsh when he does take over Haidi in a few weeks. You've got the Iran war now complicating what had been a straightforward outlook for the Fed. Before the war, they were expected to continue easing in the second half of this year. Now, of course, traders are betting they're on hold, and we have policymakers who are clearly saying they're going to stay neutral for some time. It's adding up to a very muddled outlook, I think, for US monetary policy.
And it's going to be awkward potentially for Kevin Warsh, right? Because he's coming in at a time where these rate expectations are shifting. The White House expects monetary policy to be eased.
Yeah, I mean, this kind of, I wrote earlier today, by the way, that Fed watchers are going to need more popcorn, Heidi, because really we're rolling from one drama to the next. We've just gone through the whole DOJ Powell investigation saga. That's not quite over yet, but we've just gone through that. And now, to your point, we're going to have Kevin Warsh coming along. And clearly, on the one hand, we've had a signaling from the Treasury Secretary that he has a window there, he'll have a grace period, he doesn't have to cut rates immediately. The Iran war has complicated things. We also have the President saying, no, he wants rates lower immediately, and he said last week he would be disappointed if the weren't cut straight away in the new Warsh Fed. So Mr. Warsh, I think, clearly is going to have to navigate a lot here. The economics of all of this, in terms of what the data is telling him is right for the economy, keeping on board his fellow policymakers, and of course navigating the political backdrop, which is the President who is continues to pour criticism on the Fed for not bringing down interest rates quick enough. And, he's got those all-important midterm elections towards the end of the year as well. So really several layers to this Fed story at the moment, and it just continues to add complexity as we move.
Yeah, we'll be bracing for some potential fireworks there. And the current, they're joining us from D.C. with the latest on the Fed. Of course, another part of the global narrative is artificial intelligence and Asia's AI-fueled stock rally, potentially masking signs of strain with gains in tech names overshadowing the impact of the U.S.-Iran war on the broader market. Let's get more with Asia Equities reporter Winnie Su. Winnie, so how meaningful is this divide?
Yeah, morning, Shery. This is actually something really significant that we're looking at right now. We're talking about the MSCI Asia's infotech sector really driving the rally so far, or the market rebound since the war began, up about 10% since the war began. But on the other hand, you're looking at most of the other sectors pretty much all in the red, with the consumer discretionary lagging down about 10%. And it's telling you that, yes, tech is that solo engine here. And the other sectors facing this big energy crisis as they're facing higher oil prices, especially for these oil importers in Asia. And we're seeing central banks already taking a move here, with Bank of Japan being the latest example, raising their expectation for the core CPI while cutting their forecast for growth. And similar moves that we're expecting for Thailand and also Indonesia.
So we're seeing this divergence also being reflected in earnings?
Yeah, exactly. Well, on the tech front, you have Samsung as the latest example, showing that massive beat on the AI demand, along with what we saw earlier with TSMC and SK Hynix. But on the other side of the story, the other businesses really starting to take a hit. Although it hasn't really showed up in the first quarter results just yet, you're hearing concerns already. For example, you just had Yamaji Baking actually raising prices for their bread and snacks, and also Showa Sangyo, they are raising the prices for oil, also highlighting these concerns when it comes to higher energy prices and higher transport costs.
Asia Equities reporter Winnie Su there. And coming up, we'll also be discussing India's market. The IT slowdown that we're seeing there could potentially be structural rather than cyclical, pointing to a longer-term shift, perhaps. We speak exclusively to the CEO of the Indian IT firm Mphasis next. This is Bloomberg.
Indian IT outsourcing firm Mphasis reporting fourth quarter results that beat analyst estimates. However, the broader IT firms in India remaining under pressure. The sector has emerged as the face of the AI scare trade in Asia, even as regional peers rallied on optimism around hardware build-out, and concerns over AI have reinforced investor worries about the sector's long-term growth prospects. Joining us now exclusively is Nitin Rakesh. He's the CEO at Mphasis. Nitin, really great to have you with us. And, obviously these are positive results. The broader kind of narrative or crisis of confidence in this sector, though, how has that impacted your business?
Thank you for having me, Heidi. It's great to be here. I think it's a very interesting time in enterprise tech for a simple reason that we are, over the last couple of years, starting to see emergence of the AI narrative and how that gets infused into the enterprise stack. I think instead of thinking of AI as a tack-on, this is really quite a fundamental opportunity for enterprises to take care of a lot of the legacy issues that they've been facing for many years. And it was prohibitive for them to modernize. It was not that easy to build new platforms and applications because a lot of the intelligence is locked into legacy applications. So from our standpoint, while there are lots and lots of worries around what this means from a cost of labor or the labor-driven model, but this also opens up a whole new segment of opportunity around really building foundational AI platforms, data platforms, decision layers, and truly helping enterprises identify their operations and their businesses. So I think the reason that we were able to report such strong deal wins in the last 12 months, followed up, of course, by our fourth quarter numbers for the March quarter, is really a reflection of the fact that we're able to play that cycle and that trend really well.
When you take a look at the near-term margin crunch versus perhaps the longer-term operating leverage and trade-offs, how do you contextualize that in terms of the opportunities, but perhaps some of those short-term losses that a business like yours might have to go through?
Yeah, I think the AI cycle is a little bit less like a typical deflation cycle. Yes, there are productivity gains. A lot of those gains can definitely be passed on to the client. But if you play this well, and you're truly playing the transformation game, helping clients really unlock value from their own systems and their own operations, you have the ability to actually then divert a lot of those savings into new areas, and that actually helps you create larger programs and engagements. I think the issue of margin will always be an issue in our industry where cost of labor is the biggest cost that we've had. This actually provides another opportunity to add on operating leverage if we can also adopt new ways of working. And actually, a lot of the tools that are coming out that are driving this care trade are also very, very beneficial when it comes to driving operating leverage. So infusing the set of software assets that either we build or we infuse from third-party providers like Anthropic or OpenAI gives us the opportunity to find the operating leverage as well, because issue isn't so much managing inputs, but driving outcomes that are measurable with ROI for customers. And for the right outcome and the right ROI, I don't think pricing is an issue. So I think there are multiple ways to manage the operating leverage and actually expand it for a business like ours.
But at the moment, do you see traditional services sales pools being threatened by agentic AI? Is that a defensive pricing strategy that you need to take at the moment?
Yeah, I think, there is no such thing as a defensive strategy, because from our standpoint, yes, while the unit cost is decreasing, for example, the unit cost to write a piece of software is definitely decreasing, but at the same time, the backlog and the volumes are increasing, and this new wave of spending that is coming in and building these new platforms is also driving demand. So I think it's a little bit of the yin and yang. So from our standpoint, we are using this as an opportunity to go back to customers, be transparent about the productivity gains, and use that opportunity to really drive a lot of value for them. And I think the other thing that is unique about this cycle is while a lot of the focus has been on tech spends, and that's probably historically the biggest barometer for what happens in our sector, 80% of AI spend is going to go towards driving either operations transformation or business transformation opportunities like higher revenue, better customer experience, optimization of demand and supply chain. While they'll be routed through the office of the CIO, because a lot of those require foundational AI elements, they're really driving business outcomes. So I think this focus is really more towards making sure that you understand what customer pain point can you solve and how can you align yourself with the outcomes, and from that context, I think the TAM of the market's really gone a lot bigger than it used to be in the traditional tech services play.
Tell us about your deal pipeline. How much of that is revolving around the theme of AI transformation?
About 70% of the deal wins have actually been in the what we call AI-led deals, which means there is an element of either infusing AI into the IT value stream transformation or what I just talked about, which is driving a certain outcome that drives adoption of AI. And I think agentic AI is obviously the phrase word right now, but what that really means is you should have the ability to provide these agents with the context and the knowledge of within the enterprise, as well as help make deterministic models that drive that agency. And I think the Neo IP suite that we launched last year has been tremendously helpful, whether it is IT value stream modernization, that's been our biggest driver of opportunities and deals, or even areas around business transformation that we just talked about, underwriting, mortgage, lending, supply chain. So there's a fairly strong focus on an AI native or AI first approach, which I think is resonating well, at least with our client base.
There's data showing that over 80% of enterprise AI spending expected to go towards business transformation rather than experimentation. Is that a space where Mphasis is fitting as well in terms of the broad breakdown of how much that spend will be dispersed?
Yeah, I think, again, we've made certain moves over the last few quarters, especially, I would say, the last 3 or 4 quarters. The first thing we did was we launched the Neo IP stack because that provides the ability for us to very quickly stitch together the enterprise knowledge and the context layer. Unless you have all enterprise knowledge in one location, one platform, one system of record, think of that as a digital twin, you're not going to be able to drive the workflows required for agents to operate. And of course, recently we made another acquisition of a business intelligence company out of Canada that is actually specialized in driving decision AI. And that really becomes another context, another layer on top of the context layer that helps us play in the segment that I just talked about, which is business transformation or revenue optimization.
You mentioned theory and practice business intelligence. How quickly do you expect that to translate to revenue gains?
I think FY27 should be an interesting year because we have the ability to not only infuse that as core part of our AI stack, we are also starting to see opportunities, that can be driven across the spectrum, not just for one segment of the business. So I think FY27 is going to be an interesting year. We are going to make a bunch of additional announcements around the stack and how we are not only developing it, how it has been deployed, and not only the efficiency side, but also the business transformation side. So more to come on that over the next few weeks.
Nitin, really great to chat with you. Appreciate your time with us today. Nitin Rakesh is the CEO at Mphasis. Well, India's homegrown AI startup, Sarvam AI, believes that wider adoption of the new technology could help reduce inequality rather than worsen it. Co-founder Pratyush Kumar spoke to us exclusively at Bloomberg India's Look Ahead event in Mumbai.
We all understand this, right? The world could go towards a K-shaped trajectory where few have a lot more and many people are then using a lot less, right? And I think some people anticipate it and for various reasons do suggest alternatives, right? Universal basic income being one of them. I personally think we are getting to a place where every individual is so much more capable because AI is around, right? And the access and diffusion for this to happen at a national scale in India is not a simple thing, right? We have found it hard to distribute physical infrastructure. We have done better in digital infrastructure. This is a new kind of infrastructure to be made available to everybody so that they can then play with a somewhat level playing field and do what they can in life, right? And I feel this is India's moment, and that's why I go back to the words transform and AI and growth. Actually, the level playing field that we can create out of AI is going to be far more leveling than the previous ones because a kid in Maharashtra somewhere can get access to the best tutor through AI, right? And somebody in Assam can get the best healthcare. They don't have to fly to Chennai necessarily. So I think that's India's opportunity to do that, right? And we have a large population. It's a young population. Instead of worrying about joblessness, India's white space in terms of giving better opportunities to people is so much more with AI. And it comes down to people thinking about this kind of metrics, right? Which is we talk about how much electricity people consume as a metric of development. It'll come down to how much AI you consume and how effectively you lead your personal lives and decisions based on that.
We should not be worried about joblessness?
Absolutely worried. We should be worried, right?
How much worried?
120%, yes.
No, seriously. I mean, look, you're working on a technology that is going to be a significant game changer in a country where already we have very large unemployment and underemployment, So, yeah, I mean, outside of your personal reconciliation with that, what do you think the long-term impact of this technology will be on the Indian economy?
The reconciliation is very clear. Because it is the case, you have to work on it, right? So you can't cede that ground. I think the entire world is going to go through major shifts, right? And I'm sure you guys are tracking it. But I think for me, as I said earlier, right, I think India's opportunity is actually much more positive. In fact, there was some survey that was done like a year back of how do people feel about AI, and India came out the most optimistic, either because we don't know what it is, or we genuinely are like so welcoming and for everything that's life's going to throw at you, right? But while that is a little bit tongue-in-cheek, I genuinely think India will be so much more resilient in adopting this, right? And it's about policy, it's about infrastructure, and some of this capital efficiency that is required. With that, India can pull it off, right? I believe that this will be a massive net positive. Though, will certain jobs go away? Absolutely.
I have to ask this question, though. You're working with the government in embedding Chanakya in defense systems? I mean, you've been so candid, so you would talk about this.
Yeah. So naturally, defense is a place where sovereignty as a word has more meaning. We are working across the armed forces in building components that are air-gapped and deployed for meaningful things. It requires not just building the models, but building the agentic systems around, actually understanding a lot more about what the setting there is and actually helping them end to end. So yes, we are very much forward.
Can you give us any more detail on the kind of capabilities that you're either helping build or assist?
Can't say much for various reasons, including that it's strategic sector, but you can imagine that the runway is very, very long there. There's a lot happening in that space globally, and being competitive requires us to build a lot out. And so we are involved quite deeply across the whole stack, right? From simple use cases to more complex.
Sarvam AI co-founder Pratyush Kumar there speaking exclusively with Bloomberg. More ahead on the Asia trade. This is Bloomberg.
Take a look at how futures are trading, digesting all of the mega cap tech earnings that we got in the overnight session. Very much focused on artificial intelligence spending. Of course, we had also Samsung's chip profits soaring 48-fold, really reflecting the massive spending by hyperscalers. We're also reacting to the LG Electronics reports, and that stock leading the MSCI Asia Pacific Index, reporting net for the first quarter that beat. Bloomberg Intelligence expecting a modest revenue growth for the second quarter as well. And of course, do watch out for all of those tech names that are coming online in the China and the Taiwan session as well. That's it from the Asia trade. The China show is next. This is Bloomberg.